In today's video, I'm going to share with you my investing strategy for 2024. If you're looking for a new investing strategy to consider, or you want to see a fresh perspective on investing for this year, then this video is for you. This framework is going to be built around three key market dynamics that are going on this year, including the fact that stocks are at all-time high valuations, interest rates are at recent highs, and we're in an election year. And I'm going to talk about how these three market dynamics are going to impact asset allocation across stocks, bonds, real estate, and even crypto. So, unless you don't follow the stock market at all, you've probably seen that the market has been making consistent gains throughout 2023, and that has not slowed down in 2024. And this is a problem for one reason, and that's FOMO. FOMO stands for fear of missing out, and it's the feeling you get when you see other people making money in the stock market, or you see a stock like Nvidia going up and up and up, and you feel like you're missing out, and you decide that you need to get in on the action. The issue with this is that FOMO is purely driven by emotions and not logic. And the reason that that's an issue is because this means that your investing process isn't repeatable, it's not reliable, it's not measurable, and you can't improve it over time. On the flip side, just because a stock has gone up hundreds of percent, that doesn't mean that it's a bad investment today. But the only way to know if a company like Meta or Nvidia are worth investing in is to actually sit down and do some research and make an educated guess about what you think about the future of that company. For example, Nvidia is up over 200% during the last year and over 60% just year to date. And even though it's at a $2 trillion market cap, there's nothing inherently bad about being a really big company. Of course, you should always look at more than just a company's size before you decide to invest, which is why I'm going to start creating content about my investment process and how I would analyze a stock like Nvidia step by step. Those videos are going to be a little bit longer and a little bit more in depth, but I am going to have a lot more fun making them, and I think they'll bring you a lot of value as well. So if that sounds like something you're interested in, let me know by giving me a thumbs up or hit the subscribe button so you don't miss out on that video. In the meantime, I'll leave you with this. Just because a company has gone way up in price, that doesn't mean that it's a really bad investment. And the same goes true on the opposite side. Just because a company has gone way down in price, that doesn't mean that you should buy it. Instead, you should be willing to put in just a little bit of research to learn about the asset that you're considering investing in, whether it's a stock or an ETF or real estate or crypto. At the end of the day, you're giving your hard-earned money to someone or something, and it's really important that you understand where it's going and what kind of value that might bring you in the future. And it's not just stocks that are at recent highs, it's also interest rates. As of 2024, the Federal Reserve has increased the baseline interest rate up to almost 5.5% in order to combat inflation and to try to slow down the economy. Now, the traditional thinking is that when rates go up, the economy slows down, and therefore stock prices don't go up as much as they usually do. But that's obviously not the case, especially considering lately interest rates have gone from 0% all the way to 5.5%, and the stock market has continued to notch new highs week after week, month after month. But that doesn't mean that stocks are immune to higher interest rates. That's because generally, when interest rates go up, consumers end up paying more in debt payments on things like auto loans and credit card loans and even mortgages as well. This creates less consumer spending and overall less profits for big companies. Now, some companies can raise their prices to combat this, but others don't really have that same luxury. And for some unlucky companies, this could mean the difference between being a going concern and actually going bankrupt. And when companies start to struggle with their debts, this can also put a strain on the banking system, and in some cases, it can lead to bank failures like we saw with Silicon Valley Bank. So while the stock market may be going up as a whole, if you're picking individual stocks, you could be exposing yourself to the risks of those individual companies, whether they're companies that need to raise additional debt to keep going and they just can't because interest rates are too high, or you've invested in a company like a Silicon Valley Bank that just overnight goes bankrupt. But if I haven't convinced you to just pick a broad market ETF and you're still going to go pick individual stocks, then the takeaway here is still to do your research. Now, that doesn't mean that you need to be the next Michael Burry and predict the next recession that's going to happen and make hundreds of millions of dollars from it. But by doing at least a little bit of your own research, you'll be able to familiarize yourself with the company that you're investing in and the risks specific to that company. This doesn't mean that you'll identify every single risk of that company, and there's still a lot of risk involved with investing in individual stocks, but you'll at least be able to build up your confidence in the decisions that you're making in your portfolio. The next major factor to consider is the fact that we are in an election year. Now, I don't want to get into politics or anything like that on this channel, but one question that does come up pretty common is whether Democrats or Republicans are better for the stock market. And to be honest with you, when I dug into the research with this question, I was kind of shocked. First, let's talk about the rationale, and it usually goes something like this. Democrats typically prefer higher taxes, more regulation on big corporations, and more spending on government programs. Republicans, on the other hand, tend to lean the other way. They prefer lower taxes, less regulation on government, and they prefer to rein in big government spending. And with all that in mind, it seems like Republicans would be better for the economy than Democrats. But when I looked at the data, it seems to suggest otherwise. That's because, according to a recent study from 1927 all the way through 2016, the average excess stock market return, which is the difference between stock market returns and the return you would get on a risk free investment like Treasury notes, was 10.7% per year under Democratic presidents and negative 0.2% per year under Republican presidents. With that being said, this analysis doesn't include a bunch of other factors, such as which party controls Congress during those presidencies and if there are any spillover effects from one presidency to the other. Here's the bottom line. If you're looking to make a bet purely on the numbers, then history would tell you that you would generally do better if a Democratic president is elected than if a Republican president is elected. But in my perspective, if you're looking to make a long-term investment in a high-quality company, then it shouldn't matter to you who's sitting in the White House every 4 years. Now, based on everything we've covered in this video, here's how I would construct a portfolio today. As a 30-something-year-old with a long time horizon and a big risk for appetite, my biggest holding would be stocks. However, given that stocks and interest rates are at all-time or recent highs, I would only hold about 60% of my portfolio in stocks, and specifically I would pick broad market ETFs like SPY or VOO. That's because while stocks historically have good returns, they also have a lot of risk. And the fact that I can get 5.5% virtually risk-free today is too good to ignore. And for that reason, I would hold about 20% of my portfolio in fixed income, and the ETF I would pick for that is specifically BOXX or BOX. BOX is a relatively new ETF that uses options to give you the same returns that you would get from short-term treasuries, which currently are giving you around 5 to 5.5%. And you get all the benefits of owning an ETF, which means you would benefit from long-term capital gains tax if you hold that investment for more than a year. That leaves 20% in my hypothetical portfolio to allocate, and I'm going to do a 50-50 split between real estate and crypto. The reason I would keep 10% of my portfolio in real estate is that while conventional wisdom might tell you that when interest rates go up, like they are right now, that real estate goes down because mortgages cost more. But just like as we saw with stocks and interest rates, the data shows that this simply isn't the case. Just like with stocks, higher interest rates can have an impact on real estate at the individual level, but at the macro level, there's just no causal relationship between interest rates and real estate returns. And when it comes to Bitcoin, I think that that's an asset that is just impossible to ignore. In my opinion, Bitcoin is here to stay. It's becoming more and more mainstream, and it's a piece of technology that I want to own and be exposed to. My strategy with Bitcoin is that when it's skyrocketing and it's making lots of headlines, I start reducing my position in my portfolio from 10% down to somewhere around 5%. And on the other hand, when Bitcoin is going down and nobody's talking about it anymore, then I start adding it to my portfolio and increasing my exposure from 5% to usually a maximum of 10%. I've been repeating this strategy for years, and it's allowed me to stay exposed to Bitcoin in my portfolio and make some profits along the way. Anyways, that's my portfolio that I would construct for 2024, considering all of the factors going on in the economy right now, from high stock valuations to high interest rates and the fact that we're in an election cycle. So if you like this video, make sure to like and subscribe. I wish you all the best in your investing in 2024, and I will see you in the next one.